Do you know that right now there's a company in the market that analysts are saying could jump up to 168% in the next 12 months? Yes, you heard that right, 168%. That means if you invest money in this stock today, it could potentially more than double. But here's the most interesting part. This isn't some famous tech giant, not Tesla or Apple or any household name. This is a company you've probably never even heard of before, and that's exactly why there's such a massive opportunity here. In this video, I'm going to walk you through step by step what this company does, why analysts are so excited about it, and most importantly, can it really go up that much, or is this just hype? So if you're a serious investor or want to learn how to identify real opportunities in the market, watch this video until the end because what I'm about to share with you might completely change your investing strategy. Let's first talk about what analysts are actually seeing in this stock. Right now in the current market, there are plenty of stocks that analysts recommend as a buy, but this one has something special. A full 9 analysts have given it a strong buy rating. This is no small thing, folks. When this many professional analysts agree, it means there's some serious potential here. And when I tell you what price target these analysts have set, you're going to be amazed. The current price is trading around $8 to $9. But the analyst's average target is $23.50. And the most interesting part, the highest target that any analyst has given is a full $33. Now just calculate, if the stock goes from $8.77 to $23.50, that's almost a 168% return. And if it reaches that highest target of $33, imagine what a massive return that could be. But now the real question is, what does this company actually do and why is there so much potential in it? And it's also important to understand that not every stock with a high target is automatically safe. So let me tell you everything about this company in detail. This company operates in the healthcare sector, specifically in the biotechnology industry. And when we talk about biotech, remember this industry is highly volatile, but the rewards can also be enormous. This company's main focus is on cancer treatment, specifically bladder cancer. They're developing gene therapies that directly target cancer cells. Now it's very important to understand how much demand there is globally for innovation in cancer treatment. Every year millions of people are affected by cancer and traditional treatments have many side effects and limitations. This is why companies that create novel and effective treatments have a huge market opportunity. This company's technology uses a gene therapy approach. This means they work directly with a patient's genes to treat cancer. This is next-generation medicine, and the medical community considers it the future of cancer treatment. The company is currently in the clinical stage, meaning their treatments are in the testing phase. They've already conducted multiple clinical trials, and the results are coming back promising. When the FDA approves such therapies, explosive growth is seen in stock prices. This is exactly the potential that analysts are seeing. The company's pipeline is also strong, meaning they don't just have one product but multiple therapies in development that target different types of bladder cancer. Now let's get to the main topic. This company is enGene Holdings and the ticker symbol is ENGN. You've probably heard this name for the first time because it's a relatively small company right now. The market cap is approximately $586 million. But this is where the opportunity lies, folks. When big pharmaceutical companies acquire new breakthrough therapies or when FDA approval comes through, these small biotech stocks jump 200%, 300%, or even more. ENGN's current price is around $8.77. But look at where it could go, according to conservative estimates, up to $23.50, and in an optimistic scenario, up to $33. Now let's talk in percentages. Going from the current price to $23.50 means a 168% return. And if it reaches $33, That's almost a 276% return, meaning your money more than triples. In the past 52 weeks, this stock has traded between $2.65 to $11.14. This means its volatility is very high. Sometimes it drops very low, and sometimes it shoots up. This is exactly why this stock has both high risk and high reward. The ratings analysts have given are based on the company's clinical trial results, the strength of their pipeline, and the size of the bladder cancer treatment market, which is worth billions of dollars. Major brokerage firms and research analysts who specialize in the healthcare sector are all agreeing that if the company's ongoing trials remain successful and regulatory approvals come through, there will be significant appreciation in the stock price. But now let me give you the real talk. As much potential as there is, there's equally high risk in this stock. Investing in clinical-stage biotech companies is very risky. Why? Because if clinical trials fail or FDA approval doesn't come through, the stock price can crash. This isn't gambling, but it's a calculated risk that experienced investors take. The company isn't making profits right now. They're reporting losses because all the money is going into research and development. This is normal in the biotech industry, but it means the company isn't in a financially strong position right now. You also have to look at the cash burn rate, meaning how quickly they're using their cash. If they need more funding, there could be dilution, which reduces the value for existing shareholders. To understand this stock, you need to understand the biotech sector. In this sector, small companies become acquisition targets for large pharmaceutical companies if they have promising technology. In enGene's case, if their gene therapy is successful, big players like Pfizer, Merck, or Johnson & Johnson might be interested in acquiring the company. When this happens, shareholders get a premium price. This is one possible scenario that justifies analysts' bullish targets. But the opposite scenario can also happen. If competition produces better results, or if market sentiment turns against biotech, the stock can suffer. All these factors are important to consider. Now, if you're thinking about whether you should invest in this stock, first ask yourself these questions. Can I afford high risk? Is my investment time horizon long-term? Do I understand the biotech sector? Have I built a diversified portfolio where even if this stock fails, my financial stability won't be affected? Only if the answer to these questions is yes, should you move forward. You should never put all your savings into stocks like these. This is a high-risk, high-reward play that should only be considered for a very small percentage of your portfolio. In closing, I want to make it very clear that I am not a financial advisor. This video is purely for educational purposes, so you can understand how opportunities are identified in the market and how analysts evaluate stocks. I'm not telling you to go buy this stock. I'm giving you information that's publicly available and sharing analysts' opinions. Every investor has a different financial situation, different goals, and different risk tolerance. Therefore, before making any investment decision, do proper research. Consult with a professional financial advisor who understands your personal financial situation, and never invest money that you can't afford to lose. Nothing in the stock market is guaranteed, no matter what analysts predict. If you found this video helpful, please like it, share it so others can learn too, and definitely subscribe to the channel because I regularly bring such informative videos. Thank you for watching, and remember, invest wisely, invest responsibly.